Joining us now, Seth Harris. He was the deputy director of the Biden White House National Economic Council. He was also acting labor secretary for President Obama and is now a distinguished professor at Northeastern University. Douglas Holtz-Eakin was chief economist on the White House Council of Economic Advisors under President George W. Bush. He is also the president of the American Action Forum. Seth, let me start with you. I guess we're day 5 into this, depending on how you're counting exactly. We're about an hour from the markets closing. How do you see things right now? Have things sort of stabilized a little bit?
Yeah, I think the president and Secretary Yellen and the Federal Reserve did a nice job of immediately communicating to the American people that the banking system is not at risk. There is not systemic risk in the system, that their deposits are safe on the whole, and that investors and the managers who are responsible for these 2 bank failures are the people who are going to pay the price, not unintended victims like depositors and the rest of the economy. So I think that very rapid action over the weekend has calmed the waters. We saw a little dip in Wall Street with respect to mid-sized banks. Now they're recovering slowly. The confidence level is being restored, and that is the only meaningful systemic risk to our economy, is that people lose confidence in our banking system. If that happens, we're in trouble. But the president and Janet Yellen reacted very quickly, and I think they addressed that problem.
So, Doug, as you know, there's already a debate going as to who is responsible for this. Is it the investors and bad management decisions, as Seth just laid out, or is there something more deeper here in terms of what some lawmakers are suggesting, and that is that regulation had been rolled back in 2018 in particular, the Dodd-Frank Act, and some of the regulation that specifically followed what these smaller regional banks should be doing, and that perhaps led to where we are right now. I know you were skeptical about that argument. Why?
Right. Well, I think if you look in particular at Silicon Valley Bank, what you see is a business model that was questionable to begin with. Their customer base, their depositors were narrow, all startup techs and venture capitalists. When one gets in trouble, they're all in trouble simultaneously, and they all want their money back. That's a very undiversified approach to getting deposits. At the other end of their operation, they had this heavy concentration of long-term treasuries as their capital, and they didn't manage a knowable interest rate risk. There was no surprise that the Fed was raising rates, and somehow they managed to make a terrible management decision and not move away from that as well. It's also a fact that the supervisors didn't pick this up. I find that mysterious, that the bank examination process didn't flag this. So none of that has anything to do with the actual regulatory structure. It has to do with execution within the management, execution within the bank examination process. Same results would have happened with the 2017 rules, the 2019 rules. I don't think that's what's behind Silicon Valley Bank. The one systemic thing I am concerned about, I don't know, is that we went 15 years with 0 interest rates, and I'm nervous that there's a generation of managers out there who look a lot like SVB and don't know how to manage a more complicated interest rate environment, and that's something to keep an eye on.
It's been a long time. I mean, it's been a long time since there were interest rates in this economy. Yes. I asked yesterday, I brought up the idea of moral hazard of guaranteeing deposits of greater than $250,000, and it elicited a groan in the room by us. But look, I mean, the one thing that people know is that your money was guaranteed up to $250,000. Beyond that, it's not. But now, Doug, is it?
Well, they have set a precedent that makes me very, very nervous. They have said it's all insured. There are $10 trillion of deposits in the American banking system. Is that really what they're promising? That they're going to 100% insure $10 trillion of deposits? That is a bridge too far. That, I'm worried about what they've done there. And it strikes me also as very unfair, right? This is, in the end, a consequence of the policy errors that gave us inflation, forced the Fed to raise rates. There are going to be other people who are hurt by that fallout. They're going to be carpenters, and they're going to be small businesses, and they're going to close and lose their jobs. And we're not going to do anything for them. But we stepped in and took care of these venture capitalists. I don't like it a bit.
Yeah. This is the same argument that Sheila Bair made with me in the last hour. So, Seth, let me turn to you as far as what we can now expect to see the Fed to do, at least as if they need any more crises on their plate. last week at this time, we were talking about perhaps 50 basis point interest rate hike. We got a, mixed CPI report this number. The core CPI really in question and not headed in the right direction. What do you think that Fed Chair Powell does, given what we're seeing in the banking sector in this instability?
I would be surprised if these two bank failures change Chairman Powell's perspective on the interest rate trajectory. What I hope will change his perspective is not merely that we're seeing somewhat improved inflation numbers, although we all would like to see the inflation numbers come down more quickly, but that we're beginning to see some early signs of slowing down in the labor market. There's some good news in the labor market and there's some bad news in the labor market. We saw the unemployment rate kick up a little bit, but that's because more workers are coming back into the labor market, about 200,000 in the last report. That's a very good thing. That's because wages are up. That's because jobs are available. But that also means that there will be lesser wage pressures, and we saw a slowing in wage increases. And although I don't think that wages are the reason that we have inflation in the economy, it is something that the Fed is looking at fairly closely. So my hope is that he'll pump the brakes on the increase in the rates, maybe go to 25 basis points or even zero. I think that the numbers justify going to zero. I think a lot of folks might disagree with that, but my hope is that they're going to slow down. I think this banking situation is not going to affect them very much.
Yeah, I see Doug raising his hand too. Look, there are a lot of strange bedfellows in this argument of keeping rates where they are right now and just seeing how things play out. Douglas Holtz-Eakin, Seth Harris, great to have you on. Douglas, you don't agree? You think rates should go up?
I wouldn't. They are not going to pause. They will go up.
Yeah, okay. Well, we'll leave it there. Thank you.